So what am I going to talk about today? Basically three things and then some extra goodies at the end. Number one, what is really going on in the AI market? Number two, gold has performed like crazy, all-time highs, $4,000 an ounce this year. Did I miss it? And then thirdly, what's going on in the credit markets? We've had some headlines recently and have some ideas on what investors should be looking at as that plays out.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When market uncertainty is as high as it is now, I often emphasize that the most useful people to interview are asset managers. Because they don't have the luxury of merely having an opinion on the road ahead, they have to commit capital to their convictions and be judged upon the results. Today, we've got the great fortune of having the return appearance of one of the most respected capital allocators in the business, Jan vanEck. Jan is CEO of vanEck, an asset management firm with over $100 billion in assets under management invested across its wide family of ETFs and funds, spanning equity, bond, commodity, digital, and regional asset classes. As we've done the past several quarters now, Jan and I will spend the next hour discussing his Q4 macro and market outlooks, as well as where he sees the biggest opportunities for investors right now. Jan, thanks so much for joining us today.
It's good to see you again, Adam.
It is too. I got to tell you, Jan, it is just such a pleasure and a privilege to have you come on for these quarterly outlooks. I very much look forward to them. The audience does as well. I've been having people ping me a lot recently saying, okay, isn't it time for Jan's outlook? So here we go, folks. We're gonna scratch that itch for you. So Jan, I will stop talking really quickly because I know you've provided a chart deck as you have done in the past for these. So we'll get to that as quickly as possible. I guess right before we do, if you had to pick a word or a phrase to sort of describe the macro situation right now, what comes to mind?
Happy.
Okay, like
you only give me one word.
A healthy kind of happy, or like a manic kind of happy?
I would say happy with eyes wide open. There's so many things that are changing so fast, so that's the eyes wide open part.
Okay, all right. Well, I could ask you a lot of questions about the why of that, but I think your slides are going to answer that better than any question I could ask. So why don't we jump into your material?
All right. Yeah, thanks for doing this, and my friends and clients look forward to us doing this together as well. So thank you for the opportunity, Adam. Okay, just a little bit by way of background, in case people haven't heard me before, just a little quick reminder of the perspective that vanEck brings and I bring to looking at the markets. We look at the same big drivers that other people do: government spending, monetary policy, Fed policy, and technology trends. I think what differentiates us is a little bit what I'd call our historical perspective, which is that change can be more dramatic and rapid than people might expect. And an odder range of things can happen because they've really happened before in history. So that's number one. And secondly, we try not to focus too much on daily, monthly, or weekly trends, but focus more on multi-year trends and see how they're playing out today. And then I would say that if we think the puck is headed a particular direction over a multi-year period, that gives us higher conviction, meaning sometimes you can have a stronger belief in something is going to happen in the next 5 or 10 years rather than it's going to happen tomorrow, because tomorrow is a little bit uncertain. So, and also just by way of background, there are 4 big crazy things happening in the world, but I'm not going to focus on all of these today. One is just that we are just getting through the worst ever peacetime fiscal deficit in U.S. history, meaning low unemployment, but high government spending. I think that AI is the second biggest technology that's hit America. The first being railroads. I'll refer to them very briefly. Third, that India is headed the direction of being a major consumer economy in the next 10 years to the scale, maybe not quite of China, but close. And lastly, that we've had a dramatic deregulatory act in the United States payments markets this year, but Not going to talk to it, but as big as what FDR did with the banking system in the 1930s. So I will now say, if you have no more time to listen to me very quickly, I haven't done this before, Adam, but in a nutshell, what do we think is happening? Number one, quickly, that the fiscal deficit is probably getting better than people think, estimating 4.5% to 5.5% for next year. That AI, and we'll talk a bit about this, is supporting the mega cap profitability, the fact that the S&P continues to rise on a market cap basis, and that the bigger continue to take share, market cap share. So we said this a quarter ago, that we wouldn't be surprised if they had a good quarter and that continued, and indeed it happened. If there's a cloud to worry about, it's probably some kind of growth scare that would come out of the employment markets, because we have so many things going on there, including tariffs and AI displacement. We think it's early for the de-dollarization or gold trend. We'll talk about that. And India, I don't have to talk about that. And then we'll talk about the AI plays. So what am I going to talk about today? Basically three things, and then some extra goodies at the end. Number one, what is really going on in the AI market? Number two, gold has performed like crazy, all-time highs, $4,000 an ounce this year. Did I miss it? And then thirdly, what's going on in the credit markets? We've had some headlines recently, and have some ideas on what investors should be looking at as that plays out. Does that sound like an okay agenda?
It does. I was going to tell you, I can tell you with confidence that those are all questions the Thoughtful Money audience is asking in real time right now. So very timely.
Great. Well, so for the AI stuff, I really want to talk about what exactly is going on the technology front before we get to earnings projections. So we've talked about Nvidia, but I want to talk about what is driving this huge demand for compute and the deal frenzy that we've seen. And what I'm going to propose is that the craziness of technology is the following, that I call that third bullet there, crazy mainframe math, which is the token demand is exploding, and tokens are sort of like, I'll call them words or units of knowledge in AI world. So it's basically the amount of demand for AI is going up exponentially at the same time that the costs are coming down exponentially. And the costs being twofold. Number one, the efficiency of the LLMs, large language models. And number two, the efficiency of the Nvidia hardware. So we'll drill into that. So part of the reason that I said eyes wide open at the beginning, Adam, is that there's this crazy frenzy for compute demand, and the variables are moving at unbelievable speed. So we'll look at some charts there. We've just get a refresh on what's happened to the beneficiaries of the hyperscaler demand for energy as a second bullet. And then I want to highlight a new company, I think is the new Mag 8 company. And then I want to talk about gaming as another AI winner that emerged this quarter. So, all right, so here's the crazy mainframe math. This is tokens consumed are going up 38 times year on year. And that's not just because we have a weird starting point a year ago. It's going up like 20% a month.
Right.
And there are...
Hey, Jan, I'm sorry to interrupt, but just so people understand, you mentioned it briefly, but token, is that like the inputs on which we train AI and those are going up? Or is it like the queries, like questions people are asking of AI?
Oh, no. Yeah, good point. Not queries. Think of it as words. I'm going to say words, but there's more, I think, more knowledge in there than words per se. But if most of what you're doing is processing language or words, these are the units of compute, and they break it down into what they call tokens.
All right, but again, are those like the inputs? Are those like the words or the knowledge they're putting into the LLMs?
Not per se, because you could have a query that says, when did thoughtful money start, right? Mm-hmm. That's a several word query, but then it might have to consume 1,000 words to figure out the answer to that. And that second component is token demand.
Got it. Okay, so it's the I'm going to use the word input again, but it's the inputs that the AI is grabbing to try to answer your question.
Correct. Right. It's what it's processing. I gave probably a pretty bad example just there because it was a single piece of information. But if you're trying to establish causality, like what makes a great thoughtful money podcast, right? Then that requires lots of compute. And even if you defined what great was, right, a lot of tokens would be consumed in that. And one of the things that's come out, there's two things that have emerged in the last quarter or two. One is that some of these LLMs are capable of reasoning, right? So not just spitting out an answer to a question, but exploring the thought process and showing users the logic that it used to get to an answer. So that's one. And then second of all, it's not just you and I that are asking queries of these AI chats, it's software itself, right? So a whole new source of demand for AI processing is coming out of things like robots or just software that's being developed to answer questions in a more sophisticated manner.
Okay, and on that, and I don't want to take us too far afield on this, but I have heard recently that we've trained these large language models on human-generated content, and we have kind of gotten to the end of that, where we've put about all the content that's ever been generated by humans into these models. And so the next wave of kind of information that these models are going to be trained on is going to be information that is data that's being generated by AIs themselves.
Yeah. Yes. I mean, that's another dimension, and I don't want to go too deep there, but that's, yes. Again, software is now, we used to write software and it would process data. Now software is kind of rewriting itself.
Yeah.
It's learning from the queries that it's doing. So
all right, I'm going to avoid asking the question that everybody wants to know, which is how long until it gets so smart it kills all of us, but we'll save that till the end of the presentation.
Yeah, it's like, it gets super dark. I'm frankly not worried about that sitting here today. That's why I'm happy. So but we can talk about that maybe in a deep dive. So you've got demand for tokens exploding at 38 times a year, right? Just exploding. And then the costs of processing. So I'm going to break this down into hardware and software. So this is the hardware slide. Oh, I'm realizing now it's probably too small to read, but these are the different hardware solutions that Nvidia has offered. So you can see Kepler is the one on the left, and how many tokens, how much energy it took to process a token.
That's unbelievable, the savings there.
And it's going down, like Jensen Huang, who I had the fortune of seeing last week, it's going down at 90% a year. So he plans on releasing new compute platforms every year, and he's saying that their costs are going down 90%. So that's what I'm saying. This is a crazy equation, right? Demand is, exploding and costs are imploding. And what he says that took me a long time to understand is, he says, I don't care if people my competitors give away their chips, because those people will still buy mine. And the reason he's saying that is we have an energy shortage in the US. And if his chips are 90 or 30 times more efficient than even the competitors' chips from last year, people want to consume way less energy, right? For the same amount of token processing power. So we're kind of on this hamster wheel, but it's an amazing one. That's why I'm saying eyes wide open, that we have to keep our eye as these things develop. And then the third component here is, I'll call it software. So these are the large language models. And on the left-hand scale is just the cost of processing tokens in dollars. And you can just get from the shape of the two colored lines, and I'll explain what they are in a second, that they're coming down at amazing. And these are, I think, logarithmic charts. So for those of you who are into math, they're falling really fast for the English majors in the audience. So you've got two cost components falling fast, the hardware, which we just saw, and then this is the software. Now, the two different lines are basically describing two types of LLMs. The more sophisticated ones are the ones in orange. So they score much higher on kind of, if you will, benchmarks, intelligence benchmarks of these large language models. And that's what MMLU stands for. So the ones that you and I would want to use are in orange, but the kind of lower quality ones, costs are falling even faster.
Even faster, but still the orange ones are still dropping from, I don't know, 50 to 0.75.
Yeah.
Just massive drops. Yeah.
And this is why, like, I think hopefully it's pretty clear that if DeepSeek comes out with a model that drops it a lot, there's going to be, whoa, maybe suddenly demand for compute goes down, right? But if the models start choking and don't improve on their efficiency, then all the efficiency has to come on the hardware side.
Okay.
So my main point is this is the real technology behind what's going on, and it's pretty incredible. Now, so who cares, Jan? Okay, what I would say is what we are seeing, and here's to Nvidia, we'll just use this as the benchmark for all this. What we've seen over the summer, Adam, is a huge run to lock down compute. All the different deals that are happening, and I have a chart on that later, but OpenAI wants high bandwidth memory. They want chips. Nvidia wants chips. Everyone wants more compute power because basically I think the industry realizes that demand is exploding so much that there will be a shortage of compute. And what's odd is I think Wall Street is missing it, or my colleagues think Wall Street is missing it. So, I've gone cold and hot on Nvidia stock. A year ago, July, I was a little bit cold on it because of the valuations. Now we think Nvidia is reporting that their demand is well clear visible into 2027. So 2 more years of earnings, and their valuation, their price to earnings ratio is, I would say, at the high end of a normal company, but not of a company that's growing 40 to 50% a year, which is what they're talking about. So, if those growth rates are achieved, then their forward PEs should go up as well. So the stock price should be getting a lift from higher earnings and a higher multiple. What we worry about is 3 to 4 years from now when the multiple comes down. But in the short term, we're facing a compute shortage.
Okay, I totally get that. And it's interesting. So like you, Jan, probably even more so over the past couple of years, I've had trouble wrapping my brain around how a company could be worth so much and worth so much so quickly. And I'm kind of taking from your presentation here, like I'll often talk about a trillion, like when we talk about our trillions of debt. And when you actually try to tell somebody how much a trillion is, it's a number so vast, our brains really can't fully grasp it, right? And to a certain extent, I hear you saying that the dynamics that are in play in this AI market are at such a scale and moving at such a speed that it is really hard for most people to really truly understand it. And because of all this, there's still a fair amount of demand left here that makes Nvidia's nosebleed stock price maybe fairly valued here, maybe even a little cheap right now, relatively.
Yeah, well, I also want to, maybe this is just something that everyone else knew but Jan, but Nvidia is in the semiconductor ETF. It's a chip manufacturer, but it's really not anymore, right? It's gone from just a GPU card manufacturer to now it is the mainframe of today, right? They are supplying the whole compute platform. And what's different about that is, they are the heart of the ecosystem. They are the ones cutting deals with memory suppliers or CPU with the different bits and components. Mm-hmm. But they, through their CUDA software, basically they want everyone to live in an Nvidia world, and we do, which means that it's got more competitive moats than simply being. It can't be eclipsed just if someone comes out with a faster processor. Is my point. They've got a whole competitors have a whole ecosystem, and maybe that's just Jensen Huang's sales pitch that I'm repeating, but all the deals that we saw over the summer, I think, support that thesis.
Okay. All right. I'm resisting about asking you about an AI bubble and all that stuff. We'll save those questions for later to let you go through this.
I'm trying to address it, right? And we'll have a couple more slides, but part of what I'm saying is demand is going up for something like we've hardly ever seen in our life.
Yeah.
We just have never seen.
It may not be a bubble. It may just be a super big demand surge that merits all this.
I think so. I mean, that's what I would just say. And it's easy. Let's keep your eyes on part of the hope of these quarterly sessions, Adam, is investors know what to focus on. What I would focus on, if I had to focus on one thing, is token demand, right? And if that's not going up exponentially, then I'm really worried.
Really worried. Okay. So two quick questions out of this, and I'll let you resume. I guess let's start on token demand. This kind of gets to the AI bubble question I wanted to ask you, which is, I totally get in this world why Nvidia is the darling, right? Because of all this, we need more compute. We got to invest in the platform to make all this happen, right? And largely that's happening on Nvidia technology. Now, at the end of the day, why does this matter, right? AI doesn't have a ton of value if we just make Nvidia a really rich company. It matters because we're doing all sorts of amazing new things that create a whole bunch of incrementally new value for us using AI. And to date, there hasn't been a ton of that coming out in terms of like incremental revenue or profit on the income statements of corporate America. And so the question I have for you is, are we beginning to see some of that, or is this still being sort of all taken on faith that if we feed Nvidia enough, it'll support the AI valuations that all the stocks in the AI ecosystem have?
Yeah. So I would just sort of say, yes, and that's sort of the counter. What I would say is at the super high level, the US is a consumer economy, not a manufacturing economy. And the consumer is now in a different regime of interfacing, and I'll explain this in the next couple of slides, with what it does: entertainment, purchasing, working, right? All of that, and the economics are well spoken for, but I'll get that to that in a second. So it's not that this is a toy that is unhinged from revenue. But let me give you some nuance there, because there is one weakness that I want to focus on.
Okay.
So let's just do a side trip to what we talked about 3 months ago, 6 months ago, which is there's going to be a lot of demand for electricity, and nuclear and some of these other things are going to win. I mean, this has exceeded my wildest expectations. Nuclear stocks are up 90%. Oklo, which has forget profits, has almost no revenue, is up 7 times this year.
Yeah, they don't make any energy. They haven't produced one electron yet.
I am check me, as my dad used to say, take me out, coach. I don't know what game this is. I can't say sell, because I believe in this as a multi-year trend, but I would I don't know. I just don't know what to do. Take profits. Don't get out of the position. But this is really, I would say, excessive. So just a consequence of that I want to touch on briefly is just that, and we've seen this bubble up already, which is the costs of electricity. If we have all this demand, Adam, the costs for electricity are going to go up. And so you can see here that the cost of electricity in turquoise is above CPI. This is a very regressive fact, meaning that lower income people are much more affected by an increase in the cost of electricity. And we could spend a whole hour talking about it, but I just wanted to flag this because different states are dealing with this in different ways. And I think there could be an entire reshuffling of how electricity gets done. But at least I just wanted to highlight this.
So real quick, Jan. So I was thinking about this, asking you about this before you brought up those charts showing that the Nvidia technology is becoming more and more efficient in terms of the energy needed to process tokens.
Yeah.
So I guess my question is how much do you expect this to spike, given that there will be technology somewhat riding the rescue here? So we're going to be placing a lot more demands on AI queries going forward, obviously, as it continues to grow, but they will require less and less energy per query. So does that moderate the demand it's going to place on electrons, or
not in the short term? This is part of the whole basically compute shortage, and shortages in gas turbines, and lack of nuclear. I mean, we need all of the above. So I don't. That's a good question. I don't have a simple answer on cost projections. There's a difference between what consumers get charged, which is this number, and what businesses get charged.
Right.
So,
but as there is increasing demand just for the overall electrons, people are seeing their bills creep up. We're seeing it all over. I put a tweet out, I don't know, a couple of days ago, asking if there was a betting market yet on Polymarket for when the first data center was going to get burned down by angry local residents.
Oh my God. Okay, that's a little it's a little hostile, but
no, I know, little dark. But if this line keeps going up at some point, you're going to get some real pushback, right?
No. I mean, sorry, I'm with you, just not as dark.
I know.
Which is actually the takeaway is less about AI here than about politics, because this is a whole different thing. But there's a massive difference in American sentiment and polling on a range of topics post-COVID.
Mm-hmm.
So I don't want to get metaphysical, but this, I believe, is only one of the many ingredients to that. Like, why do people feel so much pain in their pocketbook relative to the quote unquote inflation of 2.3%? And this is, I think, one of them.
Okay. All right. Well, very important. And we'll keep tracking this, I'm sure, in your future appearances. Real quick, I want to note that when you presented last quarter, I did own some Oklo at that point in time. But after your presentation, I did buy some of the vanEck Uranium ETF trust. Yeah. And that's up 76% since your last appearance here. So
nice.
You want to take a victory lap on that? Take a victory lap.
Well, I don't know. Yeah. I mean, that's why I love multi-year trends, and hate them, right? Because you knew the puck was going there over several years, but you didn't know how much was going to get priced in 2025.
Yeah.
But that's like a whole other thing. Okay. So that's kind of reviewing stuff that we've talked about before. Now, I'm going to give you two winners of AI. And again, so I know this is sort of stating the obvious, but I think I was kind of missing how powerful OpenAI is. And so I'm going to argue that it's not only a Mag 8 company, it is at the doorstep, or in fact, on a daily basis, competing with some of the other Mag 7 companies and winning. So let's just start why I'm starting this. OpenAI, I guess, was launched, I forget, 2022, I think, and it saw the fastest user adoption of anything. And so if you look at monthly active users on the right, which is the main thing on this chart, they're really the leader in monthly engagement with AI chat. And I think it's amazing to think that even Google hasn't been able to get more users on Gemini. Right. So suddenly they are interfacing directly with the U.S. consumer, to your question of a couple of minutes ago. And we'll talk about that in a second. But they are, I think they're just underappreciated. They're like our friendly little chat tool. But Sam Altman is literally competing against Gemini, I would say, and Amazon for sure. So let's dig into that. Just another way of showing how chat is winning. This is year-on-year website visits relative to the giants. Like, it's beating the giants. So Google is on the far left, no growth. YouTube, no growth. Facebook, a loss. Instagram, slight growth. Chat, of course, stands out. And you can see basically no one else has a lot of momentum. Maybe Reddit is positive. All right, let's keep going. Chat is powerful just the way Google is powerful if it's the first step for the US consumer. And so in terms of AI chats referring traffic to the sites on the left, which is where the American consumer goes, right? Amazon, Booking, Expedia, Etsy, Zillow, Carvana. Look at chat's market share.
Yeah, that's really fast. That's amazing. It's funny because I used to work at Yahoo, and in the early days when I'd yet to work there, Yahoo was sort of synonymous for the internet. You know, there were other websites out there, but everybody just thought of Yahoo when you started your whole journey there. It seems like ChatGPT is that for AI right now.
It's incredible. It's incredible. If you and I had been betting on Polymarket, would someone challenge Google for search traffic or AI chat traffic? I think it would have, a long odds.
Right. So Jan, I got to ask then, how come Google's stock price isn't getting beaten up over this? This is threatening Google's, cash cow monopoly.
Well, I think they have a whole range of businesses, number one. And number two, let's just go back here. They're number two. This may not be a winner take all. I don't think it's going to be a winner take all, but we can talk. Let me try to explain that in a second. But that's not bad, right? Plus they have so many other businesses. But let's talk about, okay, so this is just another way of showing the same thing. I'm sure you've probably never heard of these sites, Rightmove, Zoopla, and OTM, but they're basically real estate sites in the UK. And you can see that a whole bunch of maybe you can call that a small number. I don't know. 17% of their traffic is now coming through chat. So it's the same point, which is, okay, so now let me try an experiment here. I think that AI chats offer different types of services, and I want to kind of differentiate them. One is like Instagram or Facebook, where you kind of hang out with the people that you agree with, and chat tries to basically please you, and your experience is what makes chat will give you data and facts that make you happy, that will bend you from the truth.
Yeah, it enriches your echo chamber.
It reinforces it, right? It reinforces your echo chamber, exactly. And I was listening to a professor talk about how, explaining how chat would, it's like there's 2 E's in Beagle, and the user kept saying, no, there's 3, and the chat would say, oh, I'm sorry, you're right. And it's just, and that's because they weren't appreciating, yes, there is a dimension of chat that's just trying to make you happy, right? That's number one. Number two, there's a different type of chat. I'll call that the non-pleaser, where you're looking for accuracy as the value, right? And of course, you need to have accurate data. But if you're at work, or if you're answering a customer inquiry for commercial purposes, you want to please the customer, but you need to give them an accurate answer, especially when you're in the healthcare fields or the finance fields, right? And also, some of us just personally want accurate answers, not biased answers. Yeah. So I call that a second entire use case. And then third, there's shopping, and then fourth, there's gaming, and we'll talk about that. But let's just dwell on shopping, for example. If OpenAI can integrate with Shopify, they can basically compete against Amazon. So again, here, this is OpenAI is a Mag 8 company that's competing with the other ones. I mean, what's Amazon's moat against shopping if someone can access all goods and services through Shopify? And that's why Shopify stock has gone berserk over the summer. Because it suddenly got effectively, it can get around the Google, not get around entirely, but it has another source of customers, which is OpenAI.
Interesting. So yeah, you can do the same thing you do on Amazon, which is search for a product, maybe have a product recommended to you based upon what it knows of you too, and then you can actually transact. There, it's just AI plus Shopify versus having it happen all on Amazon.
Exactly, literally, Shopify provides the payment mechanism and the logistics to deliver the product to you. It won't come in a prime Amazon truck, right? But it'll still get to you.
Yeah.
So,
Does chat have an advantage on the agentic side of things over in Amazon? So in other words, you can say, look, find me a nutritious health bar and then buy it for me. And it goes off and does it all for you.
yeah, I'm not expert enough to know which platform is the best for that right now, but they're all. My main point is they're competing against each other.
Mm-hmm.
And then if you go back to this commercial application here under research app chat, the winner is OpenAI through their deal with Microsoft, right? Most companies work either in a Microsoft ecosystem or maybe a Google ecosystem. That's it. And they've won. They're partners with Microsoft, right? So they're the leading solution. And the other thing that's happening now is that as you and I use chat more and more, they're starting to emerge switching costs between the different platforms, right? Because the more we query and use one chat, the more it knows who we are and the kind of answers that we're looking for. And I would argue either that's under the social or pleaser chat or the researcher chat. It's learning more about us, right? If you upload your calendar, your contacts, all that kind of stuff, like a Microsoft Copilot, suddenly that life is really way more efficient for you as a user. So over time, these eyeballs are more, that's why everyone's fighting for market share right now.
Okay, and I'm going to ask a question that you might be answering later on, but why does this not become a winner-take-all ecosystem, right? Where the smartest AI that can come up with the best answers and do the most for me, then the network effect won't kick in, and everybody wants to use that, and then that makes it even better. And then why would I want to use the number 2 version?
Yeah, I don't know. There's definitely a scale advantage that we've talked about before, right? And let me jump ahead, and then I'll move backwards because this is such a stunning chart, and I stole this. I didn't steal it, but I borrowed it from a firm called New Edge, so give them credit.
Cameron Dawson's firm.
Yeah, exactly. And as right here, you see what happened is that retrenchment from the Mag 7 in the 22 time period in terms of their earnings. This is their earnings growth. But as soon as AI kicked in, look at this. It's like a straight line to the sky. And so this is what I think is describing the stock market these days. So I'm not sure that all of them can't win against the rest of the economy. At least they're showing a lot of earnings growth, partially because they're cutting their costs. So as you have that image in your mind, let me just go back and try to answer this is what Wall Street is all in a tizzy about, right? And part of what I try to do is sitting here in Midtown Manhattan and dealing with our active investment approach, highlight, kind of what I think they're missing. And what I said before is I think people are underestimating the compute shortage and how earnings can go up over the next 2 years. But this sort of web of consumer buying and inter-investment, I think over confuses it. To me, there's 2 things, and I've said them before, but look at this chart. Number 1, we're living in Nvidia's hardware world, right? Which is why Nvidia is cutting deals with memory suppliers, high bandwidth memory suppliers, CPU suppliers, right? They're of course wanting to deal with all the hyperscaler compute platforms. So we're living in Nvidia's world, and we're also, OpenAI is building up a compute infrastructure to compete against Google, Gemini, and every other Amazon and Meta against these others. So they are the risk you asked before, like where's the revenue? Where the revenue question, it can be very much narrowed down to where's OpenAI's revenue, because they're only printing 20 billion of revenue this year, 40 billion next year, and maybe 100 billion. So everyone else has got revenue, Adam, to pay for their compute, right? Amazon's got AWS. Everyone has billions and billions of dollars of revenue. In fact, they haven't even been borrowing to build out their compute. They had to build it anyway. So they were spending money on computers anyway. This is just the new Nvidia regime that they're switching over to. But OpenAI is the one question I would say. So I would have a completely different takeaway from this chart. Not that it's interconnected, but that OpenAI is the one firm, that doesn't necessarily have the revenue to pay for it.
Okay, and I'm sorry, what scale did you say their current revenues are on?
So, I mean, as opposed to hundreds of billions of revenue, they have maybe 20 this year.
Okay.
And like 50 or 60 next year, and then 100 billion the year afterwards. So they're borrowing a lot of money and raising a lot of money to build this compute platform, but the dream is huge.
Right.
Why are they getting that money? Because they're the winner so far.
Right, because the potential prize is so large, yeah.
Well, they're winning. They have the consumer, right? The question is, can they monetize the consumer? But they do have the consumer. So I think I'm just trying to reframe the whole AI debate here. And partly because OpenAI is not a public company, I think we're kind of missing a little bit what's going on.
Yeah, and I was going to ask about that. Do we know do they have plans to go public soon? I mean, I know that when they initially announced thinking about it, Elon had a lot of huge issues with that, but
there's no announcement at all on that front.
Okay. All right.
So anyway, I'm sorry, I got to go fast here.
Please do.
To finish the AI section, because I know we want to limit this. So the last winner, so the one winner that it kind of emerged to me that's very clear that you want to watch is OpenAI. And can they get their financing? Because that's the weak link in that whole web. And then the second winner is gaming. And so very quickly, we had the biggest take private in the history of capital markets that happened in the last quarter. I love kind of highlighting some of these things that have happened out of them because things are happening so fast. It's hard to we don't even have time to think about the significance. But I think what these investors are saying is gaming is a huge AI winner. So number one, the video experience is going to be way better. And number two, the costs of programming these games and doing the QA quality assurance is dropping dramatically. So I think what they were saying by taking this company private is that the public markets are missing that gaming is a big AI winner.
Okay, and that makes sense. We're entering into the AI is going to help us sort of enter into the era of Ready Player One, where the gaming experience just becomes so amazing and immersive. But the cost of providing that much better experience is getting driven down at the same time by the technology. So if you can own one of these companies, you're going to ride that wave.
I think that's what this headline tells us. So we're finishing up the AI story. So who cares? Jan's saying, number one, focus on tokens. Number two, focus on whether OpenAI can raise the money to pay for the compute platform, and also watch it try to compete with Amazon and frankly, a lot of the other Mag 7 companies, because that's really a quite interesting thing to watch. So those are the kind of, in a nutshell, the two things I would say to look at as we watch this. And also, I mentioned that we think that the stock market is underappreciating the compute shortage that's happening from this huge demand for tokens. So what does that mean? We see the Mag 7 earnings continue to explode. I like to say this is a chart of the US stock market history. I love the railroads, and you can see how big the railroads became as a percent of the market. So all I'm saying is the growth in the Mag 7 is not unprecedented in our financial market history, and we don't have time to go down that rabbit hole. But I just want to say it's not unprecedented. And then lastly,
sorry, just back to that chart though. The key takeaway from that is you would expect the share of this chart that's made up of the dark and light blue. Sorry, the transports are even darker, so I don't want to confuse people. But the two blues near the bottom there are going to continue to get bigger as a percentage of the pie.
Very well could be. Yeah. Likely, I would say. And then the question is, okay, when does the earnings growth of the rest of the market catch up with these juggernauts. And, you know, some people are looking at 2026 estimated earnings, and they say, okay, the Mag 7 here is expected to be 13% earnings growth. Small cap could be 22%.
Wow.
So maybe there's other parts of the market. You know, Adam, people have been holding their breath for this for years, or at least the last 2 years. But it's you know, it's conceivable. I mean, value doesn't look like it's going to be surpassing the Mag 7 in growth. But anyway, this is, I think, the thing to watch is, right, does the market smooth out a little bit? And it's you saw that in Q3. So anyway, so that's the market as a whole. I'm happy.
Okay, and I will say that's consistent with recent experts in the channel like Mike Kantrowitz from Piper Sandler and Anna Wong becoming a bit more optimistic about the economy next year, and that the profits are going to start broadening beyond just the big tech sector.
Yeah. So okay, I promised 3 topics and then a speed round. So I've used up a lot of time here to talk about AI. I'm going to be pretty quick on gold. So gold, the gold price here hitting all-time highs, well above 30 and 200-day moving averages on a technical basis. That means it's got no support. But my perspective, and I don't have a target price, I have to work on that for a future quarter, Adam, is that we've got, you know, 4 things happening, and I'll run through them very quickly. One is just the emerging markets are becoming wealthier, so they're just buying more gold, and that trend's not going to change. Number 2, I would argue this is a long discussion, but military conflicts or the threat or visibility of them are actually up. Now, I know the Mideast has calmed down over the last couple of days, but I think the Ukraine-Russia war is deepening, and China, by stopping the export of rare earths and magnets, has really told the U.S., look, your military needs my magnets. And I think that's caused more uncertainty in the world. What I call the inflation risk, I'll show you that, you know, maybe the Fed cuts rates too fast, or put another way, Trump puts too much pressure on the Fed and there's Fed independence issues. Again, I'm not going to dwell on all of these, but my main point is these things are not going away. And then the last one is budget problems with France and Japan causing government changes, prime minister changes and turmoil. It's this, I just don't see any of these things stopping. So just to you know what, I'm going to save some time. When gold has gone into different regimes, the prices has gone parabolic, and so yeah, 4,000 feels high, but it's gone up 20 times in past gold cycles. So, you know, we can again talk about that more some other time. All right. This shows,
just so you know, Jan, I mean, take the time you need here. I'm not back-ended. If you are, I understand, but I don't want you to cut things that are important to you.
Okay. All right. Well, that's good to know. Sorry. So the Zoom won't go off in an hour. Yeah. I mean, I don't know if you have any questions. I think everyone's familiar with the gold bull market of the 70s.
Yeah, I do have one question. So you talked about the inflation risk there. So you seem pretty sanguine on the economy for 2026. If the Fed does continue cutting, do you have any worries about it restoking inflation because it's cutting into a growing economy?
Well, services inflation still high. And, you know, sure, goods inflation has come down, right? But, you know, I don't know, Adam, but my point is the markets are worried about this. And I would say that it's interesting Wall Street split, right? Part of what I like to do is just to tell people who don't sit in the middle of portfolio managers all day long, half the room thinks the Fed should have been cutting, then inflation's low, and what's the problem? And the other is like, no, they don't need to move. The economy feels like it's got a lot of momentum. The financial markets are frothy almost, right? We have IPOs, You know, we have profitless companies like Oklo going up 7 times, and the Fed doesn't need to cut. So my main point is the risk is there, and I think gold is pricing that in.
Okay.
So all these things we'll be talking about, I think, in the future. The manifestation, so this is foreign central bank buying. So the context here is when central banks were selling in the dark blue line on the left, this is developed markets, meaning Europe and not the United States, but Europe, let's call it. And then since the financial crisis in 2009, the rest of the world said, you know, that US banking system isn't quite as stable as I thought it was.
Mm-hmm.
Let me like start tucking some gold away. And frankly, I'm rich, so I can start tucking some gold away. And that's what started happening. And then in 2022, after the US froze Russia's assets overseas, they said, you know what? I'm even a little bit less confident on what the United States is going to do with my money. I'm going to buy even more gold. Right. And so and they can afford to. So I just see this, like I said, I see this as a multi-decade trend. I see no reason for this to change. And so that's why, you know, gold's a beneficiary of this.
Mm-hmm.
So, and if you measure gold, now this is a little fake because gold is marked to market. And so obviously the bull market in gold has made that dark blue line go up, but it's kind of noticeable, right? That now central banks own more gold than they own US Treasuries. So this chart's been floating around over the last month or so, but I think it's significant. I think
notable. Yep.
Gold is now reemerged. We have a new regime as the world's leading currency or store of value. It's not the yen. It's not the the euro. I always say that. I do that informally to call the euro the Deutschmark, just to make fun of the Europeans. It's not the renminbi. It's not the rupee, right? It's going to be gold across those different regimes. So anyway, we can talk about more some other time. The other thing I like to point out.
This was the next question I was going to ask you. So great anticipation.
No one in the U.S. cares. I mean, I know that some of your listeners are passionate and following the gold market, and they've benefited a lot. And kudos to you and them. So, but you are a outlier. Most Americans do not care, and you can see purple just shows the prices going up, but you can see in the gray line that as a percent of total investable assets measured by ETFs and mutual funds, gold funds are not growing.
And so, sorry, we're at, sorry, that's the total assets of the gold funds. Okay.
Correct. As a percent of total.
Okay. All right. So is this, Jan, a tailwind to be that you're anticipating here? That eventually the U.S. investor will wake up and want to buy gold? I mean, what's funny is you know, I guess it took $4,000 an ounce for the mainstream financial media to start using the term debasement trade. I mean, and to me, that is the financial media like finally waking up a little bit to this, you know, maybe cracking an eye open. But do you expect at some point the gold trade to get a nice tailwind as the U.S. investor says, okay, look, I got to be in this thing?
Only when the S&P goes down significantly. Otherwise, everyone is living in this world of I'm getting wealthier. All investors are getting wealthier. Unfortunately, half of America doesn't invest, but investors are they're loving the S&P, right? What's not to like? I mean, if you're in the financial services industry, you literally don't have to do anything and your revenues are going up 10, 15% a year. It's crazy. So no, this could take years, Adam. I'm not holding my breath. Are you?
I have no idea the timing of it, so I value your point of view there, and you're not the first to say that, which is it's gonna take the, you know, basically the status quo to stumble before people start thinking about that.
Yeah. Okay. So not too late to buy gold is the short version. So we covered AI. We talked about what to look for. We talked about gold. I don't think it's early because these trends are multi-year trends.
Yeah.
And the third topic is just the private credit markets.
Yep. And sorry, real quick before you get there, just to make it practical for folks. That said, you showed the chart of gold being pretty far above its moving averages. I am guessing you would not be shocked to see a pullback in gold in the near term, but that would be more or less sort of a buy the dip moment, correct?
Yeah, I mean, it could correct significantly. I mean, look, you're looking at this 200-day moving average at what, 3,000 and 3,300, 3,400. Okay, it could easily drop $700 an ounce, easily. But I think the long-term trend is going higher. Yeah, great
Okay,
point.
Yep. Just wanted to make sure folks know that it could go down before it goes up.
Right. So let's just talk about the fixed income markets. And I basically, again, have a simple point is I have something for you to look at. If pressures develop in the credit markets, and I would argue so far they really haven't been. So I'll get there in 2 slides, what to look at. But number one is because so much lending since the financial crisis here in 2010 has happened in the private markets, the rest of us have no idea what's going on there, right? So that's a little bit why I wanted to talk about it. We know that private credit funds and the managers like Apollos and Ares have taken in billions and billions of dollars. And there have been recent events over the last month or so, Adam, 2 basic defaults, one with an auto lender and the other with an auto supplier that are making headlines. So I wanted to say, okay, what should we be thinking of as investors? And so another thing that shows this concern is that Ares, which was involved with one of the credits, is a private credit manager. This is the management company, so it manages funds that invest in these private markets. And you can say it's had quite a fall here recently, which has gotten some headlines. And we manage the largest BDC ETF, and BDCs are basically funds that invest in private credit. And so you can see here that the price of these BDCs, Adam, trades above and below what they're supposedly worth. And what they're supposedly worth is their book value. So supposedly, they're very smart accountants and everything, looking at the financial statements of what these funds are lending to and saying, okay, that's the book value. And sometimes these funds are very popular. You can see that people will pay over 10% above what they're worth because the yields are attractive. And sometimes people freak out, like during the COVID crisis or other kinds of bear markets and bonds like 2022, they'll trade at a 20% discount. So I basically have this theory that you can't redeem from these private credit funds, Adam. It's right. That's the kind of structure that they have.
Yep.
So Jan's theory is BDCs could be the escape valve. So if you own both private credit and BDCs, and you suddenly became concerned about defaults, you can sell your BDCs in the market every single day.
Correct.
And they have fallen a lot in the last couple of weeks, like 10%. I know maybe to you and me, that doesn't look like a lot. That feels very painful to BDC investors. And my basic theory is that this could easily go to a 20% discount. And because this, or even maybe more, if there were some kind of sudden concern about credit in the markets. And so anyway, that's my thing to look for, is look at these BDC prices. I'm obviously making our shareholders unhappy that own our BSD fund, I guess, or from a perverse perspective, giving them a target price for when it might be attractive to buy, which would be at a 20 or 25% discount to book value. So we're looking to put this chart. I mean, I'll share these charts through you, Adam, as always, but we're looking to put this information on our website because I think it's something to look at, because there aren't many escape valves. You know, people can't redeem from their private credit funds except for on a quarterly limited basis.
So I totally understand that. So this is interesting. So one, just in general, you're sort of raising concerns on a topic that's getting increasingly discussed of late, which is, you know, private equity, or sorry, private credit. They both have, but private credit has sort of really exploded over the past 5-10 years, and it's not regulated. It's much more opaque than the public lending space, and so there are a lot of questions of, are these guys making good loans? You know, we kind of hope they are, but we don't really know, right? We're not going to know until the bodies start floating to the surface. And then we just had Tricolor and First Brands go out, and now people are beginning to get a little scared, like, oh, whoa, maybe these, you know, these credit books are a lot worse than we were pricing in, right?
Yeah.
So, you know, you're saying, hey, the escape valve, if you're an investor in that space and you're nervous, is if you own some of these BDCs, yeah, you can sell them real quick. They're liquid, right? So it pushes the discount down here. So part of what you're saying is a warning of like, hey, if you own some of these BDCs, be careful. They might get caught in this selling pressure. Maybe you're telling people if they're real aggressive and want to try to short something, this is a short candidate to go look at. But a lot of the viewers of this channel, Jan, they first heard about BDCs from a fellow named Stephen Bavaria, who's been on the channel a couple of times, who builds these income investing portfolios. And BDCs are part of it, right? And one of the reasons why Stephen likes to do income investing is because it's all debt. And at the end of the day, debt is a contract, right? And he's like, the nice part about it is you only have the existential risk of the company to worry about. Like the company is going to pay its debt as long as it's still alive. You just have to hope the company is going to stay alive, right? Whereas if you're buying a stock, you have the existential risk, but then you have a whole bunch of other risks on top of that, right? And so where I'm getting here is there might be an opportunity here, as you're saying, Jan, where the market kind of freaks out. These things go on sale, but they then get to a place where they're priced really attractively versus the true risk inside the company itself. And so you might be able to pick up some great assets at a good value here if you bide your time and find a good entry point.
Yeah, I mean, as I said, like I like to be like the human highlighter pen and say, you know, this is something that's coming to our attention, number one, that you might not see in the headlines every day. And what you make of it is a little bit up to you, right? There's a lot of pros and cons, but it's, again, I would say it's something to keep your eye on. And the shorthand, if you don't, until we get this up on our website, just look at the Ares stock price. There's definitely a two-way market on that, Adam.
Absolutely. Yep.
And part, I would just say two things. I mean, there's other reasons BDCs may go down, because if interest rates go down, then demand for fixed income may just go down in general. But I think the question in this whole private market world is are there looser underwriting standards than you have when you have a public security?
Right.
And these two situations what you have seen is that some concentrated lending to these bankrupt counterparties, right? With several firms having over $100 million of exposure. That's a lot of money. So anyway, just something to watch.
Well, so sorry, I've asked this question a couple of times recently, so I'm glad you just put it on the table. Do you have a point of view on that yet? Of like, is there a potential? I don't know, the word reckoning might be too extreme, but like, you know, how big is the risk that we realize, oh my God, there was a lot more poor lending done in this private industry than we realized, and that could create a contagion at some point?
Yeah, I think the credit risks, and I'm just sort of repeating from what I understand from their public representation, so I don't have like an insider's view on this at all, is relatively well managed and diversified across the industry. So it's very hard for me to kind of see some kind of systemic risk at this point. But I do think there's a governance risk. And I'm just saying that, again, it's not the risk per se. It's Wall Street's perception of the risk.
Yep.
And so that's what I'm kind of saying here is that, look, in my heart, I should say I'm an ETF issuer and I love liquidity, right? But sometimes in the fixed income markets, that the demand for liquidity will drive ETFs and BDCs here to a discount. And that's really been a buying opportunity, but I don't want investors to be surprised by it.
Okay. Great point.
Okay, so I'm not even going to talk about that chart. All right, so I think we're done for the main portion. Look at exploding AI token demand, right, as something to watch, and then whether OpenAI gets the financing to build out its compute, but it's a really interesting space. Gold is part of a longer-term trend, I think, and if there's a squeeze on private credit, liquid vehicles like BDCs may be the escape valve in a negative way, but it might also be a buying opportunity. So those are the kind of 3 points that I thought were unique. Now, I want to do like a speed round because I'm conscious of not being able to talk for 4 hours. So maybe just to take another 5 or 10 minutes and just flag some things that I thought were interesting, Adam, for as you and I catch up. So the benchmark as the headline of putting together a client's portfolio is kind of 60-40 for moderate risk. And I'm just personally hearing a lot more people question the 40%, Adam. And this is just one chart I use. This is in JP Morgan does the Guide to the Markets, which I know a lot of people are familiar with. And the chart, I forget the chart on the left, the chart on the right just shows that bonds don't always move opposite to stocks. They can move in the same direction. And
we learned that in 2022, the hard way.
Right, exactly. And the temper tantrum, the tariff temper tantrum of April, the dollar didn't strengthen, it weakened, and bonds rallied a little bit, but then they didn't rally that much. So I would say, people are questioning the 40%. I don't want to get into it too much. I just think that's kind of interesting because so much of us benchmark against that. The one slide I put together for people to think about is the total return from a bond, and we've been in a 40-year bull market for bonds. So the total return, which is the third column from the right, is you can see annualized. People made a lot of money in the 80s and 90s, a little bit less so recently, okay? More as interesting, you basically don't make any money from the appreciation of bonds over time. You really make it all in the yield. And so anyways, I think that's just something for people to think about. So if bonds are yielding 4 or 5%, that's what you're going to get, all right? Don't expect to get more than that. And I think people are saying, wow, I'm getting like double that from stocks. Why do I own bonds again? And gold has beaten bonds over almost every time period. Well, definitely over every time period of recent history now. Why do I own bonds? I'm not trying to revisit 60-40 single-handedly. I'm just hearing a lot of strategists and other people sort of saying, let's have a discussion about 60-40.
Okay, just to let you know, I'm hearing that too from a number of the capital managers that I talk to on this channel. Some are developing a 60-30-10 model, some are doing some variants of that, but the thing that they're taking away from is bonds.
Exactly. I think exactly right. The starting point is stocks are fine in people's portfolios, right? It's the bond portion that people are taking money away from, and that's often the biggest question kind of in our industry. I'm going to skip a couple of slides here and leave India for some other time, but I want to talk about Alibaba. And the question is, so a year ago, talking to someone named Adam Taggart, I talked about my personal buying of Alibaba. And one of the reasons was I thought the AI component was underappreciated. And Alibaba is still cheap on that basis. And I just wanted to share with you something that I don't think is hardly known at all, which is, and this is actually original VanEck research, which is, I can't always say that. This is US electricity prices per kilowatt hour compared to China per kilowatt hour. Now, the labeling isn't really great here, but the blue line is China. Bottom line is the headline, US is twice the electricity costs of China.
Wow.
Now,
And their electrical generation capacity is some multiple of ours too.
Exploding. And so I hate to like bum you out, but what if China became a cheaper place to do hyperscaler activity? And that's an area that we could be competing with in the world. So it's a little bit more, Adam, a pin to put in here to be thought provocative, because we probably, I don't want to spend a ton of time talking about it. And I certainly am not doing some grand predictions here, but it's ultimately economies are competing on the basis of the cost of electricity. Europe, the cost of electricity, right, have gone off the charts. They're now trying to deal with it. The Mideast is very cost competitive. So anyway, I just think that it's sort of in the background here. This was something helpful to point out for people.
Okay, yeah, and this does add tailwinds to the AI energy trends that we were talking about earlier, right? Or trade, meaning, in the US, let's just look at the US at least, that is like a top sovereign priority, right? Is to build out our energy production grid so that we can match China in production capacity, but also not have this delta in the cost.
Yeah. And then one last slide, I can't stay away from the budget deficit, but I'm just going to focus on one statistic. So our federal budget fiscal years end at the end of September. And you've seen this slide for me before, at least the column in the middle, where in fiscal 2024, sorry, that was last year, right? Our budget deficit was 6.4% of GDP. Simple math. We just printed fiscal 2025, and it dropped to 5.9% of GDP. So in prior quarters, we've been talking about what will it be like for next year, because this is a hybrid Biden-Trump year. A lot of the spending that happened in September, well, all of the spending in September, October, November, December, and January was Biden spending. So a third of the year, this is a third Biden, and let's call it 2/3 Trump. So this is just, Jan has been optimistic that they're using a lot of tariff revenue and getting this deficit down as a percent of GDP. And what's happening is you saw revenue going up slightly, about revenue and outlays went up about the same, 300 billion, but that's shrinking as a percent of GDP. Right? So if the GDP is growing, that 1.8 becomes less and less as a percent.
Right.
So I'm still shooting for 4.5 to 5.5% of GDP for this fiscal year that we just started a couple of days ago on October 1st. What does that mean? It means less government stimulus for the economy, which has been offset by AI compute spending. But it means better overall financial stability, hopefully, as we crawl out from what I had been calling the reckoning of this last year.
Yeah. And does that mean you think we'll largely get out of this okay?
No, I'm just like, we should celebrate this. Like we snuck in, right? It was 6.5% or 6.4% last year. And if you read a lot of headlines in 2025 from the CBO and all that kind of stuff, they were like, Trump's not shrinking the budget deficit, it's going up even further. Wrong.
Right. And is it largely wrong because the tariff revenues are offsetting things like I mean, it just got passed, but things like the
Yes.
increased spending in the OBB?
Yep.
Yeah.
We can go through the details, but basically, yes, and yes, tariffs are the most important part of this. But listen, it's not talked about a lot, and it just flew by in the press, like it barely got a headline. So I just
Mhm.
think that if you think about the big macro factors, the risk of crisis coming from DC is marginally less, and I'm not celebrating or anything yet, but it's headed the right direction. If we have a 4% growing economy next year, and revenue and outlays stay in sync with each other, this number will come down again.
Okay. All right. So sorry, you were expecting what, 4.5 for fiscal year 2025?
No, for next, I never guessed at this year because I said it's a hybrid year, and I just had no idea. So I've always been talking about fiscal 2026 next year.
Fiscal 2026. Okay. So for a fiscal, and I guess the administration would say, hey, Jan, if you like that, you'll like the years even further because the passing of the one big beautiful bill, we were front loading a lot of the spending on it, and that spending should diminish in future years as a percent of GDP. And we should start getting tailwinds from all the other policy stuff that we're doing, and the economy should grow even more, and that should narrow the deficit even further. Will that happen? Who knows? But I think that's what they
Yeah,
tell you.
exactly.
Yeah.
I just think it's worth focusing on the scorecard, right? And
Yep.
what we miss, again, and this is why I love doing this quarterly outlooks with you, is sometimes the scorecard like flashes by so fast and we lose it, and suddenly we're focusing on Taylor Swift's wedding or something else.
No, I
So
appreciate you doing that very much. If I can, let me just ask you one question on something you flew over, and we can do the deeper dive next time. But you skipped over India. I know you've been pretty bullish about India for a number of the different quarterly outlooks we've done together. I don't follow it as nearly as closely as you do, but I think the Indian stocks have kind of taken it. Some of the winds come out of their sails over the past quarter.
yeah,
So just in a sentence or two, what are your thoughts here? Hey, temporary, the party's going to continue again, or is there something more material going on here?
they've done the structural reforms that they need to, and now the economy just needs to grow into them, was my base case. I've got even more good news because they're passing a bankruptcy law reform, which basically means that companies will go bankrupt in a more orderly and quicker manner, which means more efficient capital usage and better um, risk management, if you will, in the economy, which is fantastic. So yet another structural reform seems to be in the works. It's not done, but it's almost done. I would say in terms of buying, we don't quite, yes, markets are down. We don't quite have the full buy valuations that I would love. I would say we're close to the price to book being pretty attractive. PE, not quite as much. So if you don't own any, I'd certainly buy half a position. But we don't have so much as to, overweight.
Okay, got it. And like I said, next time, to the extent that things are still somewhat similar,
Oh,
give you a chance to really go deep into it.
and because I love making predictions, and I love
Mhm.
having these recorded, I predict that the U.S. will cut a tariff deal with India in the next month at 15% tariffs.
Okay. All right. Well, I hope you're right. First and foremost, I will say too, Jan, I think we noted several of them in this past hour, but I think more often than not, your predictions have actually come pretty close to the mark, at least the ones that you've made here with me. You get a good track record, so hopefully you don't spoil it.
Some good wins. Yep.
All right. Well, look, Jan, fantastic as always. Most important question for folks that would like to follow and track vanEck's work and learn more about their family of funds, where should they go?
Yeah, our website has all our fund information, vanEck.com, and I'm on X, Jan vanEck #3, and I'm also on LinkedIn. I will share great great pods, like some of some of Adam's pods. So thanks, thanks, and appreciate again the platform. As you know, I did a shout out to you on Josh Brown.
You did. You are
Which,
such a good friend of this platform.
which a lot of people have commented to me on. So it's good.
That's great, Jan. Well, like, thank you. And again, we'll continue doing this as long as you've got the interest and the energy. It really is wonderful. And Jan, when I edit this, I'll put up the links to vanEck.com as well as your social media handles there, so folks know exactly where to go. But yeah, my friend, thanks so much. I know these require a fair amount of time to put together. You know, I think you've said they're helpful in helping you sort of structure your thinking for the next quarter, which is great. But I know that it's an expenditure of energy on your part. Really appreciate it.
And we'll get you the chart pack as well, because I know that always comes up. So
yes, thank you. And yes, so
perfect.
folks, the chart pack will be available in the Substack write-up of this. It'll be available for free to anybody. So if you don't already sign up for our Substack, just go to thoughtfulmoney.com/newsletter. You can sign up for free.
And it's we'll get you latest tomorrow morning. You know, compliance always needs to polish every vowel.
All right. Well, it should be ready by the time this video launches. But anyways, folks, please do me a favor. Thank Jan for just doing his usual bang up job here by hitting the like button, then clicking on the subscribe button below. Jan, my friend, again, I'm just super appreciative of this and look forward to doing this with you in a quarter.
Great. Thanks, Adam. Good luck.
All right. Everybody else, thanks so much for watching.